This is your LMAX exchange technical update for Thursday, December 28th, 2017. Euro dollar. So the euro still confined within a range. Key levels to watch: the 2017 high, which is about to be the 2017 high for good. It looks like at 2093, and then we have that 115.55 November base. The euro has been showing signs of being very well supported on dips over the past several months, despite this market being in a consolidation. And we have to remember that the market is coming off a big move, a big breakout in 2017 that would suggest that if we're going to see trend continuation, well, then it should be to the top side. A break above 120.93, where that 2017 high is, would open a measured move extension up towards the 126 area if you consider the consolidation that we've seen between 120.93 and 115.55, that November base. If we break back down below 115.55, the market would potentially see a drop down towards the 112 to 113 area, but that would not compromise the still medium-term outlook, which favors additional upside in the euro. So overall, a constructive outlook, but short-term, the market is still needing to break out of this consolidation that we've seen, which leaves the short-term directional bias quite neutral. Sterling dollar. So cable, a very strong year in 2017, making a series of higher highs and higher lows throughout, most recently putting in a 2017 high up at around 136.60. And so the market now looking to confirm that next higher low at 30.25, and that will be confirmed on a break of the 2017 high, which would open a measured move extension, considering the 36.60 to 30.25 move of about 6 big figures up towards the 142 area. Here, only back below 130.25 would delay but not compromise the constructive outlook for sterling dollar. Really, here we would need to see a breakdown below 27.75 to give reason for concern. Dollar yen. So dollar yen not doing much of late, but the market overall has been consolidating for a good portion of 2017. Rallies well capped above 114, dips well supported down below 108. The market now has been consolidating up around the range highs, but we have most recently stalled out by that range high, which it does leave the door open still for the possibility of a downside break. The market would need to establish back below 112 at a very minimum to start to really put the pressure back on the downside, while critical support right now comes in around 110.85. That's the low that we had seen back on the 27th of November. A break of that low would encourage and strengthen the outlook for a return towards the base. Euro Swiss has been pressing up on an ongoing basis to fresh 2017 highs. It's been a slow go, but ultimately, after breaking out above 110 and 112 in 2017, it was a big year as it was representing a constructive a significant shift in the overall structure, now favoring a move back towards the top side, and the focus now is clearly on a retest of that base that was broken down in January of 2015 all the way up in the 120 area. Any setbacks that we see along the way should be very well supported, and ultimately only back below the 112 area would compromise the bullish outlook for Euro Swiss right now. Aussie dollar. So Aussie dollar in the process of extending a correction out from recent multi-day lows. The market now looking like it could be poised for another upside move towards some resistance up around 79. 79 is the high that we had seen back in October. And so that's where the market could be headed over the coming sessions. At this point, look for setbacks to be supported, and ultimately at this point it would only take a breakdown below 75 again to really put the intense pressure back on the downside. So a little bit more of a neutral outlook for Aussie right now. Short term, there is the possibility for the market to push up, and on the downside, the market would need to establish back below 75 to open the door for a continuation of real declines. And so we'll see how things play out with Aussie dollar. Dollar CAD now back towards the bottom of a range. The market could trade down into the 125s and 126s this week. Less relevant to see how it responds given the lighter, thinner trade on the holidays, but it will be interesting to see how dollar CAD handles this drop down towards what has been a consolidation phase. The market ultimately, though, is in a recovery off the 2017 low and should be supported on dips that we see down towards 124, and only back below 124 would compromise the recovery outlook, which continues to favor additional upside. So short term, it's possible that dollar CAD continues to extend lower, but should be supported, well supported in the 124s in favor of another upside extension, eventually back above that 129.21 critical high that we had seen right now, going back to late October. Kiwi dollar. So the New Zealand dollar continues to extend its correction out from recent 2017 lows. This market did see a 2017 low in November. The inverse head and shoulders like formation has been triggered. The market breaking back above 69.80 also was significant, opening the door for a move back up towards the 72 area, which is a measured move and also happens to coincide with those highs that we've seen back in October. SPX 500. The S&P 500 continues to push to record highs on an ongoing basis. There has been no sign of any onset of any even short-term correction of meaning in this market, and so the market continues to push, and unless we see a breakdown, which we believe needs to be below the 2550 area, then nothing changes and the market could continue to extend this run well beyond 2700. And so that's going to be where we need to focus on a short-term basis. As far as resistance goes, you have to be thinking in uncharted territory, just mid-figure, big figure type of a translation with this market. So you're thinking 2750 and then 2800, etc. Again, in uncharted territory, and that's what we're looking at. But ultimately, 2550 needs to be broken to the downside to suggest that we could be seeing some form of an exhausted market that's ready to relent after an intense trend over the past several years. Gold. So gold has been ultimately constructive. It's been choppy, but ultimately since 2016, this is a weekly chart, has been very well supported into dips. There have been some intense periods of weakness we've seen over the past several months. Most recently, we saw an intense dip in November, but again, well supported, and the market could be looking to make a run now back towards the 2017 high up around 1357, and then for a retest of the 2016 peak, a critical peak at 1375, a break of which would be a major development, opening the door for a much bigger move in gold potentially. For now, on the downside, while the market holds above 1200, the market remains constructive, and only back below that level would really compromise the constructive outlook for gold.